The Federal Reserve held rates steady today, but minutes later, Microsoft and Meta both reported earnings, and the market handed them opposite verdicts. Microsoft was up about 7 to 8% after hours, while Meta dropped around 7.5%.
Both companies are committing enormous capital to AI expansion. So today we have two linked questions to answer. What exactly did the Fed defer? And why was one AI expansion rewarded while the other was punished? Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us start with the Fed. They held the target rate at 3.50 to 3.75%, but the vote was 9-3. Beth Hammack, Neel Kashkari, and Logan all wanted a 25 basis point hike.
That three-way split is really unusual. It is the first time we have seen three dissents in the same direction at a meeting since 2016. And Kashkari is the important human signal there, because historically, he has been a prominent dove.
Right, and Fed Chair Kevin Warsh rejected the idea of a soft inflation target. He essentially told markets to play the ball, not the referee.
Exactly. Plus, quantitative tightening remains over. The principal is fully reinvested, with no new balance sheet tightening. Put those pieces together, and a hold with three hike dissents does not feel like dovish relief.
It feels more like they just kicked the can down the road.
Yes, it leaves September unusually uncertain. They did not remove the inflation risk. They just deferred the immediate hike.
The two-year yield fell roughly 4 basis points to around 4.24 to 4.27%. But the 10-year rose roughly 7 basis points to around 4.67%.
And the 30-year yield jumped roughly 10 basis points to around 5.20%, the highest since 2007. It is a bear steepener. Less immediate hike risk, but more long-run inflation concern, term premium, or fiscal supply. The curve shape alone cannot prove which.
Look at the close. S&P 500 7,316.15, down 1.52%. NASDAQ 24,442.94, down 1.74%. Dow down 2.19%. But industrials, falling 3.9%, was the worst sector, not technology.
Energy rose 1.88%. WTI crude hit $84.68, up 6.84%. And Brent reached $90.73, up 7.92%. A commonly used quote endpoint displayed the wrong sign on oil today. Always recompute the number before building a narrative on it.
Good data hygiene lesson. Interestingly, the IGB software index closed up 0.64%, while the SOX semiconductor index fell 5.38% and the SMH fell 4.79%.
The broader market and Fed mattered broadly, but software closing green while semis collapsed proves another distinct mechanism was operating under the surface.
Microsoft reported revenue of $90 billion, up 18%, and operating income of $40.6 billion, up 18%. The stock popped about 7 to 8% after hours.
Azure and other cloud services grew 43%, beating the roughly 39 to 40% guidance by about 3 points. They guided Q1 fiscal 2027 Azure to around 45% in constant currency.
Annual Azure revenue surpassed $100 billion for the first time. Total fiscal 26 Microsoft Cloud revenue was about $214 billion, with nearly 90% from customers outside frontier model companies.
That shows demand is broad, not just OpenAI. Commercial RPO hit $678 billion, up 84%. With sequential growth driven by non-model developers.
CapEx and finance leases were massive at $41 billion, up 69%, mostly short-lived CPUs and GPUs. Free cash flow was $19.64 billion, down 23%, but strongly positive.
One reporting distinction matters here. Fiscal 27 CapEx guidance was around $175 billion, while calendar 26 stayed around $190 billion. Those are different periods. And the $39.3 billion figure belongs to the broader intelligent cloud segment. Microsoft does not report Azure as a separate dollar total.
Okay, but we need to keep this balanced. Microsoft had some accounting help this quarter, right? A $3.2 billion Anthropic gain contributed roughly 27 cents to EPS. And OpenAI investments were a net gain of $480 million, or 7 cents EPS in Q4.
Yes, though management says the headline operating beat remained even excluding those discrete items. But there are real quality flags. Commercial RPO growth decelerated to 84% from 99%.
And they extended the useful life of their buildings from 15 to 25 years.
Right, which reduces future annual depreciation on that asset class and helps EPS. Also, lease reclassification can make the reported Q1 fiscal 27 CAPEX look like it is above $50 billion without an equivalent new cash spend. Plus, that 23% drop in free cash flow is a real cost.
But there is positive evidence too. Their fiscal 27 operating margin decline is guided to less than 1 point, much better than feared.
Exactly. They are still capacity constrained. They added 31 data centers in Q4, bringing the fiscal 26 total to 88, plus about 1 gigawatt of power. Microsoft is not flawless, but the operating evidence remains strong.
Meta dropped about 7.5% after hours. Revenue was actually strong at $60.801 billion, up 28%, beating the roughly $60.2 billion consensus.
Core ads are healthy. Ad revenue up 27.5%, impressions up 14%, price per ad up 12%. Daily active people reached 3.60 billion. Operating cash flow was $31.862 billion, up 24.7%.
So why the sell-off? The Q3 revenue guide of $61 to $64 billion is about 1% light at the $62.5 billion midpoint versus roughly $63.1 billion expected. EPS was $6.18 versus $7.13 to 22 cents expected. The first miss after repeated beats.
Margin compression is severe. Operating margin was 30.9%, down from 43% a year ago. CAPEX was $31.08 billion. Free cash flow plummeted to $784 million, down 90.8%. That is a 1.3% margin versus 18% a year ago. $2.4 billion in legal charges and about $1.18 billion in severance explain part. But even adjusted margin is lower. This is not only one-offs.
Long-term debt increased by roughly $24.9 billion in the quarter to $83.66 billion. Buybacks were zero. Their $1.353 billion dividend exceeded quarterly free cash flow, and net cash fell sharply.
Reality Labs was not the main incremental problem. Family of apps margin compressed, with fiscal 26 CAPEX raised at the lower bound to $130 to $145 billion. And 27 notably larger enterprise monetization payback is pushed later. That is why this does not look like a demand problem. It looks like a strong core facing strained cash conversion.
Wait, hang on. Isn't Meta deliberately investing ahead of returns? Mark Zuckerberg has always done this, and it usually pays off. Why is the market punishing them for building the future?
I agree with you. That can be a completely rational strategy. The missing information is the timing, not necessarily the eventual value. Think of it like two busy shops that both decide to expand next door.
Okay, so Microsoft is the first shop.
Yes. Microsoft pays the builders for the massive expansion, still leaves $19.6 billion of cash in the register, and actually guides its main growth engine faster. Meta is the second shop. It has incredibly strong lines out the door and great sales too. But its expansion consumes nearly all of its current operating cash, and it adds debt. Both are growing. But
the difference is how today's business funds tomorrow's capacity. The payback clock is just later for Meta.
Exactly. The market is not rejecting the AI-capex thesis. It is evaluating demand breadth, near-term guidance, current free cash flow, the funding method, and payback visibility. Naturally, one quarter cannot prove who the long-term winner will be.
Why did the semiconductor index fall over 5% today, despite good earnings? KLA beat and raised their 2026 wafer fab equipment outlook to the low $150 billion range, yet fell 10.8%.
Corning Optical Communications grew 32% and guided up, but fell 12.1%. Bloom non-GAAP EPS was 78 cents versus roughly 41 cents expected, but its after-hours gain round-tripped entirely. SK Hynix revenue grew 257%, operating profit up 557%, but missed extreme expectations and fell over 15%. Vertiv dropped 17.3% after softer guidance.
So why are good results punished? Is CapEx demand breaking?
No, CapEx demand remains intact. These different company stories show good results no longer justify the old price automatically. The tape looks like a crowded momentum unwind. Options market estimates put SOX in negative dealer gamma, while SOXL daily rebalancing, Korean leveraged product selling, and AI-capex multiple repricing add pressure.
Honestly, a lot of people are just blaming short sellers.
Mid-July short interest data does not support that. NVIDIA was 1.39% float shorted, Micron only 0.8 days to cover, and SOX short interest fell. Data lags after July 15th, so we do not overclaim, but multiples and positioning are repricing.
Rotation is clear. 1 month observed price action. Salesforce up 20.25%, Apple up 16.88%, ServiceNow up 16.60%.
Versus Marvel down 45.15%. Coherent down 43.71%. KLA down 43.59%. Lam Research down 41.76%. And Applied Materials down 39.63%.
We should interpret that cautiously.
Yes. Software and AI users with lower visible external financing need outperform direct CapEx recipients right now. This does not mean CapEx recipients lost their businesses.
And Korea raised the minimum cash margin on single-stock leveraged ETFs from 10 million to 30 million won, advancing the effective date to July 31st.
Those products reportedly took around 14 trillion won retail and were down 70 to 75%. The finance minister apologized. It gives a mechanical seller a checkable date. If intraday volatility compresses after July 31st, mechanics may be fading. No guaranteed rally, but a key date. Looking ahead to Thursday, we have Amazon and Apple earnings, plus GDP and PCE data in the same window.
So what are the 4 things we need to watch to prove this combined thesis?
First, watch hyperscaler CapEx and their free cash flow. Second, watch whether positive semiconductor prints are finally bought rather than sold. Third, see if that Korea-driven volatility compresses after July 31st. And fourth, watch whether the 30-year yield stays above 5% while the short end reprices.
That brings us to the closing question. Can the Fed contain long-run inflation uncertainty while AI builders show that their spending actually converts to durable cash?
The CapEx thesis remains intact, but the market scorecard now includes demand breadth, cash conversion, funding structure, and the payback clock. One night clarified the rules, but it did not settle the cycle.
We will see how Thursday's numbers change that scorecard. Thank you for listening. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.